to Asset Preservation Hour with Stewart Willis, an Asset Preservation Wealth and Tax CEO and founder, of course. How are you this week?
Oh, man, I'm living the dream.
Thanks so much for having me host with you this week. We are all watching the news and biting our nails and wondering what is happening right now in the markets.
Well, I think, it's just been incredibly volatile. We're seeing some crazy movement in the markets. We've, come off this amazing market, and we've seen obviously lows here. And so a lot of people are trying to figure out, are we at bottom or not? And, time will tell. I think there's still some more blood in the streets to come. So, you don't want to be taking too much risk with those portfolios right now, especially if you're nearing retirement. But I think the one word on everybody's mind is inflation. Are we at peak inflation? Yeah, I think we're pretty close. I think it's not getting very much higher. And I know Biden came out, the other day and said, hey, inflation has dropped. No, it hasn't dropped. It's just less than it was last month. So we have,
right. It's still up.
It's still growing. It's still, it's still high. It ticked down a little bit last month, and so we'll see where it goes from in the future. But listen, things are getting more expensive. We did see that big tick down in fuel prices, but that's, we don't believe that's permanent. Until we really solve the supply issue there could be some further turmoil in those markets. And of course, we're still dependent on, foreign sources of oil, which is a big issue. That
is a big issue. What do you do for your clients to kind of protect them from the big downturns in the markets?
Well, I think number one, people just have to know their options. I think people don't know what their choices are. People that have been in, with their advisor forever, they think that they're kind of stuck with them forever. And I think that it's kind of like a bad relationship, right?
Yes.
Even bad relationships, people stay in for way too long.
That's right.
They realize that, hey, this advisor, he's a nice guy or she's a nice gal, but they just aren't performing and they're not communicating. And I think more than anything, listen, everybody saw downturns here at the beginning of the year. So even our portfolios did. We're not immune to that. But the important thing is that you have communication and that your portfolio, matches what's going on right now. Because if you're in the same portfolio you were, 2 years ago, well, that's probably a problem, right? Yeah. It needs to make sure that in this crazy environment, in this very risk-ridden environment, that your portfolio can protect you against your downside. Because I see so many people that have worked their entire lives, they've done their jobs, they've put away all this money into their 401ks, their IRAs, their thrift savings plans, and now they're seeing it all go.
Yeah, it's terrible.
And I think it's really important. One of the options people have is, for example, for people that are still working, they're concerned, do I have to keep working? I had a client come in the other day that said, hey, you know what? I think I need to retire so that I can pull out my 401k. Well, here's the good news. You don't necessarily have to quit your job. If you're 59 and a half, you may have the option to have your 401k rolled over to an IRA to have it professionally managed. That also goes with your thrift savings plan or your deferred comp or your 403b if you're a nurse or a teacher or a doctor, right? It's not available for everybody, and it's also not good for everybody. There's some downsides, like loan provisions, for example. In your 401k, you can generally borrow against your 401k.
I didn't know that.
Yeah, and the question is, are you okay not doing that? Right?
Yeah.
Most people, when they retire, they end up defaulting on their 401k loans anyways, and it creates a massive tax consequence. But you need to know your option. If you're 59 and a half, you have concerns about your portfolio, you may have the ability to roll it over. You just need to seek help to see if it's right for you.
We've always heard the word diversification, ride the roller coaster. But if everything you have are in stocks and bonds, that doesn't mean diversified, right?
Well,
I mean, what are the other options? Where does the money go?
Yeah, so oftentimes, we'll see clients that'll come in. They'll have, 50, 75, 150 positions inside their portfolio, and they feel like they're diversified, right? Because they have all of these different things. Well, what we've noticed oftentimes is that when it comes to these individual mutual funds or ETFs, oftentimes all their funds are all buying the same exact stuff, right? So if all of them are buying a company like Microsoft, for example, great company, if 10 of your mutual funds all buy Microsoft and they all buy Apple and they all buy Tesla and they all buy all these great companies, they all do the same thing, right? Maybe they're all reacting in the same way historically. So what we do is we test that diversification. So I think it's really important to make sure you do have a diversification of investments, which is diversified between stocks and bonds and asset classes and so forth. But I think it's also important to make sure that you have some fixed investments in there. What we mean by that is that you need to have a certain portion of your assets that are completely immune from the market volatility, because oftentimes it doesn't make sense to take risk with everything. And I'll tell you, our clients will come to us and say, hey, you know what, this portfolio, it's down 10% this year. And I'll say, well, no, it's not. You have this fixed asset over here that hasn't lost a thing. And they'll say, no, but we're not concerned about that. But you have to be. You have to look at the whole picture. It's really important. So if you have half your money fixed and safe, the other half in the market, and the market part is down 10%, and your fixed part is down nothing, you're only down half of that, right? You're down 5%. You're not down 10. So I think it's important to make sure that you have some investments that are safe and fixed and long-term as well. But when it comes to diversification, it's not just diversification of investments. It's also a diversification of perspectives. What I mean by that is that most financial advisors that you sit with are the guys in there picking your mutual funds for you.
Yeah.
And I think that's a tremendous risk because, the one thing I'd say is, as smart as they are, they may use bigger words than me. They may even be smarter than me. And it's entirely possible. My wife lets me know all the time I'm not that smart. But I think what's important to realize is this one question. If your life savings is being invested by your financial advisor, you're gonna bet your entire life's work that advisor's right. I think it's a tremendous risk. At Asset Preservation, we want you to have a diversification of perspectives. So we use multiple money managers. We have a money manager, biggest money manager in the world. Kind of a left-leaning money manager. Some people don't like them. When we mention their name, they hate them, in fact. We have some, a tactical money manager that's an algorithm money manager, pretty conservative, group that, one's based in San Francisco, the other one's based in Arkansas. And we have a Newport Beach based money manager, conservative California, a guy named David Young, brilliant guy, spent 14 years at one of the biggest bond houses in the world. But here's the point. They're not all going to get it right all the time, just like you won't if you're picking your own positions. If you have concerns that you are not properly diversified, then I just say this, give us a call, or even easier, pick up your phone, click on that QR code that's in the corner of your screen, and what we're offering you is a complimentary portfolio review. You can speak to myself or one of my advisors about whether or not you're taking too much risk. Are you properly diversified? Do you have multiple perspectives being reflected in your portfolio? What we're offering to you is that complimentary portfolio review, but you have to take action. Give us a call at 833-652-7829, or even easier, click on that QR code. It'll take you right to our website. We'd be glad to help.
And remember, this is no obligation, no pressure at all. Leave your checkbook at home. It's not about that at all. It's just about getting to know you and mapping out your plan and seeing what they can do to help you get to retirement even sooner, and very conveniently, of course. Stay with us more right after this.
This is the story of how you get from here to there. Right now you're here, but in the future, you want to be there. And from here, there looks pretty good. But so few get to there. Why? Well, of those who do make it, some will have luck, but most will have a strategy. They will save and invest, grow and protect, and they will work with advisors who will help guide their way. If you're looking to get somewhere, to get there, we know how to set a course. It's what we do, and we do it well. We're investment specialists, retirement advisors, insurance experts, and financial planners. We have innovative wealth tracking tools to monitor your progress every step of the way. Wherever you are now, we can help you get to where you want to be. The road between here to there is shorter for those who know the way.
Welcome back. We were talking about diversification. And Stewart, I have a question. Diversification and, of course, changing people's perspective, which is so important because we were never taught any of this in school growing up. Are there any other things that you could diversify?
Yeah, absolutely. So the other thing we can look at is a diversification of tax classes. And what we mean by that is that, most people have done their job. They've listened to their, to the people on TV or to their advisors. They've put away all their money tax deferred, but they've built up these massive tax time bombs. And what happens is they go into retirement and they've got all this money tax deferred, and then they end up never using it because they don't want to pay the tax bill on it, right? And so I think it's really important to make sure that you not only have your 401k, your IRA, but also the Roth. You want to make sure that you have some other tax-free assets as well. And if you don't have tax-free assets in your estate, it's a big issue. Now, when we talk about tax-free, we're not talking about after-tax money. We're talking about truly tax-free. I think tax planning is a huge part of it. And if you don't have Roths in your portfolio, or you don't believe you have enough, it's worth taking a look to see if it makes sense for you. The other thing we talk about is the diversification of investment strategy. So a lot of people will take this passive approach, where they're kind of buyers and holders. They just buy it and sit on it for the next 20 years. And for a lot of people, that's worked, especially over the last decade or so. But maybe it makes sense to introduce multiple strategies in there as well, like we do with our money managers. So like I said before break, we have one manager that is a, biggest money manager in the world, and they see the world one way, but they use a very strategic approach. Our algorithm money manager is very tactical, right? They basically have identified 6 distinct stages in the economic cycle. And they basically say, look, when we are in recession, there are investments that do better than when we are in a growth mode or in a recovery mode, right? So they actively switch. And what if you're, in these portfolios that haven't, been tested against these recessions, or aren't built for recessions, or aren't built for inflation? There's just a lot of risk in making sure that, you haven't done that stuff.
And there's a big risk in not having that written out blueprint, that if you've been with someone, an advisor for years, and you haven't had these conversations about your exact plan and how to move forward, then you really do need to call Stewart and his team. Now, diversification of tax classes, what does that mean?
Yeah, so once again, it's about having that IRA and that Roth. And, if you've already done your job, how do you accomplish this, right? You're nearing retirement, you've put money away for 20 or 30 years. Well, that's when we start talking about the Roth conversion, right? You actually have to put into perspective that we are in the most efficient tax window in history right now. Taxes are on sale. They're at a discount. It makes sense in many cases to take advantage of your bracket, because look, the way I look at taxes are like this. Going from the 10% bracket to the 12% bracket is a small jump. Jumping from 12 to 22 is a huge jump.
Yeah.
The next bracket is 24, which is a small jump. And after 24, we have the 32, which is a huge jump. So you want to make sure you're taking advantage of your tax brackets, using every dollar inside of it. But remember, there are some pitfalls in there. Right between the 22 and 24% bracket, there's something called IRMA, which is a Medicare penalty. And a lot of people try to do it themselves, the Roth conversions, and they end up getting all these penalties and higher taxes on things they didn't even know existed.
Right, and the tax code is the same for everyone. You just have to be very educated to kind of know the difference and know how to take advantage of it. So why aren't other advisors having these conversations with everyone about the Roths, especially because there's such great tax benefits?
Yeah, I think that, most advisors realize that Roths are better, but they don't have the tools, or they're prohibited from their firms for talking about, tax planning. And I think that's the one thing that people need to know, is that your advisor has the ability to consult on those things. And honestly, a lot of advisors just don't want the liability of a big tax bill. Had a client come in the other day that they were in a loaded mutual fund position. And what we mean by that is that's a brokerage relationship. And we have seen advisors starting to trend to try to be fiduciaries, to be fee-only advisors. Mm-hmm. But what we saw is this lady, she's an older, advisor that's been around a long time, has had this other client that's, she's in her 70s. She's a phenomenal woman. She's had her money with this advisor for years. And look, these advisors haven't had to do anything. They leave them in these, loaded mutual funds. And you can tell if you have a loaded mutual fund, because you look at the mutual fund, and if you see an A, B, C, D, or E behind it, those are generally loaded mutual funds. And the reason, yeah.
What does that mean, loaded?
Well, loads mean, for an A share, for example, you're paying to get in. A B share, you're paying to get out. C shares are combinations, and there's other variations of those. But basically, the advisor, gets paid to either put you in or take you out, as well as getting paid by the mutual funds themselves. So as a fiduciary, as a Series 65 licensed investment advisor representative, I'm not allowed to receive any of those fees from mutual funds. So as a fiduciary, you never have to worry about whether me steering you in the direction of this security or that security is because I get paid by them. I don't.
Yeah,
I get paid by our clients. Well,
it's a huge difference between you, an independent fiduciary who's licensed, or the big box, because they have products to sell that they must sell.
Yeah, and it's one of those things where even if they're well intended, oftentimes they have sales quotas to hit. And I just think as a fiduciary, it's important to make sure that the plan really fits you, that the risk really fits you, that the product really fits you. And if you are second guessing whether or not, hey, my advisor's a fiduciary, or are they just being a broker and selling me stuff? Are you avoiding those phone calls because every time the broker calls, they're trying to make a commission? Well, then you need to find somebody that is a fiduciary. And I think it's really important to make sure you're finding somebody that you get along with, that you can communicate with. Because, listen, I tell people all the time, first of all, we have amazing advisors at our firm. And I'll tell you straight up, if you don't like me on TV, you're absolutely not going to like me in person. Don't bother calling. You can call Rebecca if you want, right? But I think it's important.
They'll love you.
No, listen. I mean, I am the same guy in person, and it's important to make sure that you can communicate. When people say, "Hey, Stewart, you work 6, 7, 8 days a week, right? 8 days. Is there an 8th day now?"
That's a Beatles song,
right? It's true, but it's because I'm doing business with people I enjoy.
Yeah.
It's people I like. My clients have my cell phone number. If you're a financial client, you have my cell phone number. And when we were on our recent trip to Italy, my wife was a little upset because I was getting calls at 11 p.m., 12 a.m. in the morning in Italy. And she was upset. I said, honey, we're in Italy because of the clients that have put their life savings with us. We've been building this relationship for, 20 years. So you need to make sure you're dealing with someone you enjoy communicating with, because if that communication isn't working, especially in these volatile times, it's a problem. Now, if you think that you're in a relationship with your financial advisor, don't call me about your husband. If you're in a relationship with your financial advisor that you think needs some work, or maybe they're not considering taxes, or they're not considering estate planning in your financial plan, then all you have to do is pick up your phone, click on that QR code that's right at the bottom of your screen. Even easier, give us a call. 833-652-7829. We'd be glad to help. You can't get a second opinion from the person who gave you the first. So try it, give us a call.
Absolutely. And stay with us more with Stewart Willis right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life, and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Thank you for staying with us. I'm Rebecca Powers. So happy to be with you this week as Stewart Willis is giving us such fabulous complimentary information on TV, radio, and of course when you come into the office to meet him. Stewart, what are the things that people should be looking for in their financial planner?
Yeah, I think when it comes to a financial advisor, you want to make sure, first of all, they have resources, right? Real planning resources. And what we mean by that is that, they are a fiduciary, number one. I think that's the most important thing. So what a fiduciary is, once again, is someone who puts your interest above their own. We've seen commercials where they say, hey, we do better when you do better. It's, I think it's important to realize that whether your money makes money or falls, advisors still get paid, but you just want to know that everything they're doing is in your best interest. So number one, they have to be a fiduciary, right? That should be a deal breaker. It doesn't work if you're not, number one. Number two, you want to make sure that they have a tax planning department inside their company. And by a tax planning department, I don't mean the advisor that turns on his software program and says, looks like this $20 a month program said you should convert to Roth. That's not what we're talking about. We're talking about someone that has a real tax office built into them. And I think it's super, super crucial. When it comes to investments, I think taxes are a major part of your future and whether you're going to succeed. And more importantly, important to whether or not you're going to be able to actually enjoy your life's work, because what people do is they paint themselves into a corner, they build up all these tax deferred assets and never get to enjoy their money. So a tax plan allows you to actually enjoy your money and not get absolutely hammered by the tax man. So I think that's super important as well. The next thing is, do they do estate planning? Now, asset preservation, we just celebrated our 25th year in business here this year. We started as an estate planning firm. And what we mean by that is that, we do estate plans like living trust. We do that. We've had the same relationship with the same attorney for 15 years. So I think it's important that your advisor understands trust, that can be there with the resources so that when you're gone, that your kids are taken care of or your surviving spouse have everything in order. A will and a trust are super crucial. I would also say beware of those living trust mills. And what we mean by that is, if you're seeing in your local newspaper or a digital ad a living trust for $5.99 or $6.99, you have to think about it. Sometimes things are too good to be true. In California, there were a bunch of lawsuits about these living trust mills, and one of their operators has just moved here to Arizona. And what they're doing is they're selling you living trusts. And then what they're doing is gathering all your personal information, and then they're trying to sell you financial products on the back end. So just be wary of that. Yeah, it's what they call a pretext interview, and we think it's a tremendous mistake, illegal in California. Arizona doesn't seem to have as big of a problem with it, but I think ethically it's one of those things to think about when you see a cheap living trust. Now, here's the one thing. At Asset Preservation, we only do estate planning for our financial clients. So yes, we do estate planning. We don't make any money doing estate planning, but we do it to make sure that if we're going to be your advisors, if I'm making a commitment to you and your family, you want to make sure there's one thing I require. To become a client of ours, the one thing I require is that things are in order. And now I'm going to help you, right? Our firm is there. That's why we offer estate planning, because I don't want to hang out with your kids or your surviving spouse in probate court.
Right.
It's unnecessary.
Explain what probate is, because that is crucial what you're saying. It's a worse situation than you could ever imagine.
Yeah, so probate is basically the system, like if you've created a will, a lot of people think, oh, I've done my planning, I have a will. Well, what a will generally does when you cross the probate threshold, let's say you have a piece of real estate here in Arizona, obviously it's over the $60,000 or $80,000 probate threshold. Probate is when the court comes in and determines who should get your money. Now, it's not an evil process. It's not a bad process. It's just a lengthy and expensive process. So when I say it's not a bad process, it's not, these aren't bad people. They're just expensive attorneys. And so attorneys want to make sure you go through this process because it creates another revenue stream for them. And I just tell you this, do it in advance. If you plan ahead, you can do it for pennies on the dollar. You make it easy for your kids, for your survivors. Make sure that your financial advisor can talk about these trusts as well. So super, super important. The other thing, are they insurance licensed? Do they understand what kind of plan goes into, in insurance planning? And can they do the cash flow modeling? A lot of people are there to sell you a product, but they can't cash flow it out. And what we mean by that is your money going to last for a lifetime? Because some advisors are really good at growing the money, but can they make sure that they can take you to the finish line? You know, that's the important thing. Can they get you to cross that red zone? It's an important thing to look for.
Because how can you retire if you don't know exactly that on the first of the month you're going to be able to pay your bills, and you don't know exactly, especially with longevity. People are living so much longer now, right, Stewart? Do you see that as kind of one of the risks, too, with planning?
Yeah, absolutely. And listen, there's a bunch of tools out there that some are good, some are bad, like annuities, for example. Some annuities are great. Some are absolutely horrible, and they have all these fees attached to them, or they're variable with the market. You've seen that you were promised this 7% guaranteed this or that, and they just haven't performed in that way. You just want to make sure that if you're in these, goofy products that you don't understand, you seek help, that you get a second opinion on them. It's like reverse mortgages, right? Reverse mortgages, kind of like annuities, have a bad name. Some are good, some are bad. I'll tell you an example. I just had a client come into this office here. So this office, a lot of people don't realize, is our Tempe office. So whether you come into Sun City office or you come to our Scottsdale or you come here to our Tempe office, this is where we film the show, is at our Tempe office. It's awesome. But anyways, client came in here, had me on the phone with their reverse mortgage specialist, and they were actually told that if they took a reverse mortgage out and didn't take any money out, they'd be making money on their money. Their money would grow at 5%. Well, no, it wasn't their money. They didn't make money on their money. The line of credit extended. Yet they still had to pay $20,000 or $30,000 in fees. So if somebody's trying to sell you a reverse mortgage, if you have substantial assets in retirement accounts and you want to know whether they fit well together, all you have to do is to get a second opinion is give us a call. Even easier, pick up your phone, click on that QR code that's in the bottom of your screen. It'll take you to apsitaxes.com. Or once again, I'll give you that phone number. It's on the bottom of your screen, 833-652-7829. If you have concerns about your portfolio, if you have concerns about your future, are you taking too much risk, then take action today and give us a call.
Absolutely. And if you have not had these conversations with your financial advisor, then it is definitely the time, especially with the market volatility right now. Thank you so much for joining us. There's the number one more time, 833-652-7829. Come meet Stewart Willis and his amazing team. Thanks for being with us, Arizona.